In Chapter 6, we will cover the overall objectives of the audit, the auditor's responsibilities in conducting the audit, and the specific objectives the auditor tries to accomplish. By the end of Chapter 6, you should be able to do the following. You should be able to explain the objective of conducting an audit of financial statements and an audit of internal controls. Be able to distinguish management's responsibility for the financial statements from the auditor's responsibility for verifying those financial statements. You should also be able to explain the auditor's responsibility for discovering material misstatements due to fraud or error, be able to describe the need to maintain professional skepticism when conducting an audit. In addition, by the end of Chapter 6, you should be able to describe the key elements of an effective professional judgment process, be able to identify the benefits of a cycle approach to segmenting the audit, be able to describe why the auditor obtains assurance by auditing transactions and ending balances, including presentation and disclosure, be able to distinguish among the management assertions about financial information. Also, by the end of Chapter 6, you should be able to link transaction-related audit objectives to management assertions for classes of transactions, be able to link balance-related and presentation and disclosure-related audit objectives to management assertions. And lastly, you should be able, by the end of Chapter 6, explain the relationship between audit objectives and the accumulation of audit evidence. We will begin by discussing the objective of conducting an audit of financial statements and an audit of internal controls. The preface to the Clarified American Institute of Certified Public Accountant Auditing Standards indicates that the auditor's primary focus is the section that emphasizes issuing an opinion on the financial statements. For larger public companies, the auditor also issues a report on internal control over financial reporting as required by Section 404 of the Sarbanes-Oxley Act. If the auditor believes that the financial statements are not fairly presented or is unable to reach a conclusion because of insufficient evidence, the auditor has the responsibility of notifying users through the auditor's report. Subsequent to the auditor's issuance of the report, if facts indicate that the financial statements were not fairly presented, the auditor will probably have to demonstrate to the courts or regulatory agencies that the audit was conducted in a proper manner and the auditor should reach reasonable conclusions. In here, we have a summary of the 5 steps to develop audit objectives. The first step is to understand the objectives and responsibilities for the audit, followed by dividing the financial statements into cycles. Knowing management assertions about the financial statements, knowing general audit objectives for classes of transactions, accounts, and disclosures, and lastly, knowing specific audit objectives for classes of transactions, accounts, and disclosures. You can find Figure 6-1 on page 143 of your textbook. The first step to developing audit objectives is to understand the objectives and responsibilities for the audit. So our next discussion will cover distinguishing management's responsibility for the financial statements from the auditor's responsibility for verifying those statements. The responsibility for adopting sound accounting policies, maintaining adequate internal control, and making fair representations in the financial statement rests with management rather than with the auditor. Management's responsibility for the integrity and fairness of the representations or assertions in the financial statement carries with it the privilege of determining presentations and disclosure it considers necessary. If management insists on financial statement disclosures that the auditor finds unacceptable, the auditor can either issue an adverse or qualified opinion report or withdraw from the engagement. The Sarbanes-Oxley Act required the Chief Executive Officer and the Chief Financial Officer of publicly held companies to certify the quarterly and annual financial statements submitted to the Security Exchange Commission. In signing those statements, management certifies that the financial statements fully comply with the requirements of the Securities Exchange Act of 1934, and information contained in the financial statement fairly presents in all material respects the financial condition and results of the company's operations. In here, we have an example of a section of an annual report of a publicly held company that includes a statement about management's responsibilities and its relationship with the certified public accounting firm. You can find figure 6-2 on page 144 of your textbook. Moving on, we will now discuss the auditor's responsibility for discovering material misstatements due to fraud or error. The American Institute of Certified Public Accountant Auditing Standards state that the auditor is responsible in obtaining reasonable assurance about whether the financial statement as a whole are free from material misstatement, whether it is due to fraud or it's due to an error. In addition, the auditor is also responsible for identifying material weaknesses in internal control over financial reporting. When is misstatement considered material? Misstatements are usually considered material if the combined uncorrected errors and fraud in the financial statements would likely have changed or influenced the decisions of a reasonable person using the financial statements. Although it is difficult to measure or quantify materiality, the auditors are still responsible for obtaining reasonable assurance that this materiality threshold has been satisfied. So what is assurance? Assurance is a measure of the level of certainty that the auditor has obtained at the completion of the audit. Auditing standards indicate that reasonable assurance is a high but not absolute level of assurance that the financial statements are free of material misstatements. The concept of reasonable but not absolute indicates that the auditor is not an insurer or guarantor of the correctness of the financial statements. There are several reasons why the auditor is only responsible for reasonable but not absolute assurance. The first reason is Most audit evidence results from testing a sample of a population, and sampling includes some risk of material misstatement of not being identified. Also, the areas to be tested, the type, extent, and timing of those tests, as well as the evaluation of test results, do require significant auditor judgment. In addition, accounting presentations contain complex estimates which inherently involve some form of uncertainty and can be affected by future events. As a result, the auditor has to rely on evidence that is persuasive but not convincing. And lastly, fraudulently prepared financial statements are often extremely difficult, if not impossible, for the auditor to detect, especially when there is collusion among management. In conclusion, the auditor's best defense against liability when material misstatements are not uncovered is for the auditor to conduct the audit in accordance with the auditing standards. Auditing standards distinguish between two types of misstatement: a misstatement that is due to error versus a misstatement that is due to fraud. An error is an unintentional misstatement of the financial statements. For example, an error would be a mistake in extending price times quantity on a sales invoice. In contrast, fraud is intentional misstatement of the financial statements. For fraud, there is a distinction between misappropriation of assets versus fraudulent financial reporting. Misappropriation of assets is usually committed by employees. For example, a sales clerk takes the cash at the time of sale and does not enter the sale in the cash register. This would be an example of a misappropriation of asset. In contrast, fraudulent financial reporting is usually committed by management. For example, management intentionally overstates sales near the balance sheet date to increase reported earnings. Auditors do spend a great portion of their time planning and performing audits to detect unintentional errors made by management and employees. Auditing standards make no distinction between the auditor's responsibilities for detecting errors versus fraud. The standards do recognize that fraud is often more difficult to detect because management or the employees who are committing the fraud attempt to conceal the fraud. Still, the difficulty of detection does not change the auditor's responsibility to properly plan and perform the audit to detect material misstatements, whether it is caused by error or it is due to fraud. Both fraudulent financial reporting and misappropriation of assets are potentially harmful to financial statements, but there is an important difference between them. Fraudulent financial reporting harms users by providing them with incorrect financial statement information for their decision making. And fraudulent financial reporting is typically committed by management, sometimes without the knowledge of employees. Management is in a position to make accounting and reporting decisions without employees even knowing about it. An example would be management's decision to omit an important footnote to the financial statements about a pending litigation. In contrast, misappropriation of assets is harmful to creditors, stockholders, and others because the assets are no longer available to the rightful owners. And usually, misappropriation of asset is perpetrated by employees and in some instances by employees and management. In obtaining reasonable assurance that the financial statements are free of material misstatement, the auditor takes into account applicable legal and regulatory frameworks relevant to the client. One of the difficulties for the auditor is determining how laws and regulations impact financial statement amounts and disclosures. The auditor's responsibilities regarding non-compliance with laws and regulations, also frequently referred to as illegal acts, depend on whether the laws or regulations are expected to have a direct effect on the amounts and disclosures in the financial statements. If a law or regulation has a direct effect on the financial statements, the auditor should obtain sufficient appropriate evidence regarding material amounts and disclosures that are directly affected by the law and regulation. For example, in auditing income tax expense to identify whether there have been any material violations of federal or state tax laws, the auditor might hold discussions with client personnel and examine reports issued by the Internal Revenue Service after the completion of an examination of the client's tax return. The provisions of certain laws and regulations, such as tax regulations for our particular example, are generally recognized to have a direct effect on the amounts and disclosures in the financial statements. For laws and regulations that do not have a direct effect on the financial statements, the auditor is not responsible in providing assurance. However, do note that compliance with those laws and regulations is often fundamental to the operation of a business and necessary for that business to avoid material penalties. Examples would include complying with the terms of an operating license. The auditor should perform procedures to identify instances of non-compliance with other laws and regulations that may have a material effect on the financial statement, such as inquire of management and those charged with governance about whether the entity is in compliance with such laws and regulations, as well as the auditor must inspect correspondence, if any, with the relevant licensing or regulatory authorities. If the auditor becomes aware of information concerning a client's non-compliance or suspected non-compliance with laws and regulations, the auditor should obtain an understanding of the nature and circumstances of the act. Additional information should be obtained to evaluate the possible effects on the financial statements. The auditor should also discuss the matter with management at a level above those involved with the suspected non-compliance and, when appropriate, those charged with governance. The auditor should obtain sufficient evidence regarding material amounts that are directly affected by laws and regulations. Laws such as those relating to taxes and pensions usually have a direct effect on the amounts or disclosures in the financial statements and therefore will require the auditor's attention. Unless the matters involved are inconsequential, the auditor should communicate with those charged with governance on matters involving non-compliance with laws and regulations that do come to the auditor's attention during the course of the audit. The auditor should also identify whether a responsibility exists to report the identified or suspected non-compliance to parties outside the entity, such as regulatory authorities. Auditing standards require that an audit be designed to provide reasonable assurance of detecting material errors and fraud in the financial statements. To accomplish this objective, the audit must be planned and performed with an attitude of professional skepticism. Professional skepticism consists of two primary components: a questioning mindset and a critical assessment of audit evidence. There are 6 elements of professional skepticism: a questioning mindset, a suspension of judgment, a search for knowledge, interpersonal understanding, autonomy, and lastly, self-esteem. A questioning mindset means that the auditor approaches the audit with a trust but verify mental outlook. A suspension of judgment pertains to the auditor withholding judgment of the client and the related financial statement until appropriate evidence is obtained by the auditor. An element of professional skepticism requires that the auditor search for knowledge, where the auditor must desire to investigate beyond the obvious and have a desire to corroborate audit evidence and information. Interpersonal understanding involves the auditor's recognition that people's motivations and perception can lead them to provide biased or misleading information to the auditor. Autonomy is the self-direction, moral independence, and conviction to decide for oneself, rather than accepting the claims of others that is expected when performing the audit. And lastly, the auditor must have self-esteem. Self-esteem means that the auditor must have the self-confidence to resist persuasion from others and to challenge assumptions or conclusions. When auditors embrace the responsibility to maintain a questioning mind and to critically evaluate evidence, they significantly reduce the likelihood of audit failure throughout the audit. The profession has developed professional judgment frameworks that illustrate an effective decision-making process to assist auditors with maintaining professional skepticism when professional judgments are made during an audit. We will discuss the key elements of an effective professional judgment process. The 5 key elements of the judgment process consist of the identification and definition of the issue, followed by the gathering of the facts and information, as well as identification of the relevant literature, then performance of analysis, and the identification of potential alternatives, followed by the decision-making of the auditor, then a review and completion of documentation, as well as the formulation of the rationale for the conclusion. In here, we have an illustration of the 5 key elements of an effective judgment process. The starting point to an effective professional judgment begins with identifying and defining the issue by carefully analyzing the situation and its potential effect on the audit. With the problem defined, the auditor then seeks to understand the relevant facts and available information concerning the issue. When gathering facts and information, the auditor should be alert for other information that either confirms or contradicts facts and information, in addition to evaluating the sources of that information. The next element of the professional judgment process involves analyzing the issue based on the facts and information gathered, as well as the relevant authoritative literature identified. Once the analysis of the facts and information has been completed, the auditor then applies judgment to make a proper decision. After making the decision, The auditor then should step back and evaluate the judgment process to determine that all of the key activities in the judgment process have been appropriately performed. As the auditor articulates in written form the rationale of his or her judgment, the auditor may find that reasoning appears faulty or incomplete and therefore is not persuasive. This, in case, should direct the auditor to evaluate which aspects of the analysis and judgment process may warrant his or her further consideration. The process of documenting helps the auditor to be more objective and complete in assessing the reasoning used in reaching a judgment decision. You can find figure 6-3 on page 150 of your textbook. Auditors should be alert for potential judgment tendencies, traps, and biases that may impact the decision-making process. In here, we have a table that includes 4 common judgment tendencies and related strategies to avoid them and mitigate the bias. First is the confirmation judgment tendency. This is the tendency to put more weight with initial beliefs or preferences when dealing with information. To avoid confirmation, the auditor must consider alternative explanations and potentially disconfirming or conflicting information. Next is the overconfidence tendency. This is the tendency to overestimate one's own abilities to perform tasks or make accurate assessments of risks as well as judgments and decisions. To avoid the overconfidence tendency, the auditor must challenge opinions, experts, and underlying assumptions. The anchoring tendency is the tendency to make adjustments insufficiently away from the started initial value. To avoid this tendency, the auditor must solicit input from others and consider management's bias, including the potential for fraud or material misstatements. And lastly is the availability judgment tendency. This is the tendency to consider information that is easily retrievable or what's easily accessible as being more likely or more relevant. To avoid this tendency, the auditor should consider why something comes to mind, obtain and consider objective data, and consult with others. You can find table 6-1 on page 152 of your textbook. We have completed the discussion on the first step to developing audit objectives, which is to understand objectives and responsibilities for the audit. We will now move on to the next step, which is to divide the financial statements into cycles. Audits are performed by dividing the financial statements into smaller segments or components. The division makes the audit more manageable and aids in the assignment of tasks to different members of the audit team. After the audit of each segment is completed, including interrelationships with other segments, the results are then combined. A conclusion can then be reached about the financial statement taken as a whole. A common form of segmenting is called the cycle approach, which divides classes of transactions and account balances that are closely related into segments. The cycles used in your textbook are the sales and collection cycle, the acquisition and payment cycle, the payroll and personnel cycle, the inventory and warehousing cycle, and lastly, the capital acquisition and repayment cycle. The logic of using the cycle approach in audit is that it ties to the way transactions are recorded in journals and summarized in the general ledger and financial statements. In here, we see an illustration of the flow of transactions from journals to financial statements. To the extent that it is practical, the cycle approach combines transactions recorded in different journals with the general ledger balances that result from those transactions. You can find figure 6-4 on page 153 of your textbook. In here, we have an illustration of the application of cycles to audit using the December 31st, 2016 trial balance for Hillsburg Hardware Company as an example. A trial balance is used to prepare the financial statements and is a primary focus of every audit. The letters S, A, B, C, and I shown in this illustration represent a cycle for each account in the left column beside the account name. Observe that each account has at least one cycle associated with it, and only cash and inventory are part of two or more cycles. This slide is a continuation of the trial balance from figure 6-5 of our previous discussion in the last slide. You can find figure 6-5 on page 154 of your textbook. In here, we have an example of the accounts for Hillsburg Hardware Company by cycle, and it includes the related journals and financial statements in which the accounts appear. In this particular example, all general ledger accounts and journals for the company are included at least once. For a different company, the number and titles of journals and general ledger accounts will differ, but all will still be included. In addition, some journals and general ledger accounts are included in more than just one cycle. And when that occurs, when you're performing an audit, what that means is that the journal is used to record transactions from more than one cycle, and it indicates a tie-in between the cycles. The most important general ledger account included in and affecting several cycles is the general cash or cash in bank. General cash connects most cycles, while the sales and collection cycle is the first cycle listed and is usually a primary focus on most audits. Collections on trade accounts receivable in the cash receipt journal is the primary operating inflow to cash in the bank. The capital acquisition and repayment cycle is closely related to the acquisition and payment cycle. Transactions in the acquisition and payment cycle include the purchase of inventory, supplies, and other goods and services related to the business operations. Transactions in the capital acquisition and repayment cycle are related to financing the business, such as issuing stock or debt, paying dividends, and repaying debt. The inventory and warehousing cycle is closely related to all other cycles, especially for a manufacturing company. The cost of inventory includes raw material, which is related to the acquisition and payment cycle. Manufacturing includes direct labor, which also relates to the payroll and personnel cycle. And the manufacturing overhead relates to multiple cycles, such as the acquisition and payment cycle, as well as the payroll and personnel cycle. You can find table 6-2 on page 155 of your textbook. In here, we have an illustration of the relationships among transaction cycles. The transaction cycles illustrated in here relates to the cycles of a manufacturing company. Do note that cycles have no beginning or end except at the origin and final disposition of a company. A company begins by obtaining capital, usually in the form of cash. A manufacturing company uses the cash to acquire raw materials, fixed assets, and related goods and services to produce inventory. These transactions relate to the acquisition and payment cycle. Cash is also used to acquire labor for the same reason, which relates to the payroll and personnel cycle. Acquisition and payment and payroll and personnel are similar in nature, but the functions are sufficiently different to justify separate cycles. In a manufacturing company, the combined results of these two cycles is inventory, which in turn relates to the inventory and warehousing cycle. At a subsequent point, the inventory is sold and billings and collections will result. These transactions relate to the sales and collection cycle. The cash that is then generated from the sale is then used to pay dividends and interest or to finance capital expansion, and this will start the whole cycle process again. Take note that cycles in this illustration are interrelated in much the same way for a service company, except there will be no inventory for service companies. In summary, transaction cycles are an important way to organize audits. For the most part, auditors treat each transaction cycle separately during the audit. Moving on, we will now discuss the audit objectives related to transactions, adding balances, as well as presentation and disclosure. Auditors have found that generally the most efficient and effective way to conduct an audit is to obtain some combination of assurance for each class of transactions and for the ending balances in the related accounts. For any given transactions, several audit objectives must be met before the auditor can conclude that the transactions are properly recorded. These objectives are called transaction-related audit objectives. Similarly, several objectives must be met for each account balance. These objectives are called balance-related audit objectives. And the third category relates to the presentation and disclosure of information in the financial statements. These objectives are called presentation and disclosure-related audit objectives. Auditors conduct financial statement audits using the cycle approach by performing audit tests of the transactions making up the ending balances. In here, we have an illustration of this concept by showing the four classes of transactions, which are cash receipts, sales returns and allowances, charge of uncollectible accounts, and sales, that determine the ending balance in the accounts receivable account. Assume that the beginning balance for the accounts receivable is $17,521, was audited in the prior year, and therefore can be considered fairly stated. If the auditor could be completely sure that each of the four classes of transactions is also correctly stated, then the auditor could also be sure that the ending balance for the accounts receivable of $20,197 is also correctly stated. Before examining audit objectives in more detail, let us first discuss management assertions about financial information. Knowing management assertions about financial statement is the third step in developing audit objectives. Management assertions are implied or express representations by management about classes of transactions and the related accounts and disclosures in the financial statements. Management assertions are directly related to the financial reporting framework by the company, usually which is U.S. Generally Accepted Accounting Principle or the International Financial Reporting Standards, as they are part of the criteria that management uses to record and disclose accounting information in the financial statements. Management assertions lead to the audit objectives. Therefore, auditors must have a thorough understanding of management assertions whenever performing quality audits. The Public Company Accounting Oversight Board standards describe 5 categories of management assertions. The assertion that assets or liabilities of the public company exist at a given date and recorded transactions have occurred during the period. All transactions and accounts that should be presented in the financial statements are included. Assets, liability, equity, revenue, and expense components have been included in the financial statements at appropriate amounts. The public company holds or controls rights to the assets, and liabilities are obligations of the company at a given date. The components of the financial statements are properly classified, described, and disclosed. In addition, international auditing standards and the AICPA auditing standards further divide management assertions into 3 categories. The assertions about classes of transactions and events, assertions about account balances, and lastly, assertions about presentation and disclosure. In here, we have the mapping of the Public Company Accounting Oversight Board assertions to the assertions in International Auditing Standards and the AICPA Auditing Standards. The first 3 Public Company Accounting Oversight Board assertions are applicable to account balances and classes of transactions. Presentation and disclosure is treated as a single assertion. International auditing standards also provide additional assertions related to the Public Company Accounting Oversight Board valuation or allocation assertion, besides separating the assertion related to transactions from the assertions to presentation and disclosures. Please take the time to read this table. You can find table 6-3 on page 159 of your textbook. We now move on to the next steps in developing audit objectives, which is knowing general and specific audit objectives for classes of transactions, accounts, and disclosures. We begin with the transaction-related audit objectives. The auditor's transaction-related audit objectives follow and are closely related to management assertions for classes of transactions. There is a difference between general transaction-related audit objectives and specific transaction-related audit objectives for each class of transactions. For the general transaction-related audit objectives, there are 6 objectives. The objective that recorded transactions have actually occurred, followed by the objective that all transactions that should be included in the journal have actually been included or recorded, the objective that recorded transactions are stated at the correct amounts, recorded transactions are properly included in the master files and are correctly summarized, transactions included in the client's journals are properly classified, and lastly, the objective that transactions are recorded on the correct periods or dates. After the general transaction-related audit objectives are determined for the audit, specific transaction-related audit objectives for each material class of transactions can then be developed. The specific transaction-related objectives are tailored to the specific class of transactions being audited. At least one specific transaction-related objective should be included for each general transaction-related audit objective, unless the auditor believes that the general transaction-related audit objective is not relevant or is unimportant in the circumstances. Do keep in mind that for each management assertion, there are general transaction-related audit objectives as well as specific transaction-related audit objectives. In here, we have an example of the relationship among management assertions, the general transaction-related audit objectives, and the specific transaction-related audit objectives. For each management assertion, there are general transaction-related audit objectives as well as specific transaction-related audit objectives. Notice that there is a one-to-one relationship between the assertions and objectives except for the accuracy assertion. The accuracy assertion has 2 objectives because of the need to provide auditors with guidance in testing transaction accuracy. Please read Table 6-4. You can find Table 6-4 on page 162 of your textbook. Balance-related audit objectives are similar to the transaction-related audit objectives that we just discussed. Presentation and disclosure-related audit objectives are also similar to both transaction-related and balance-related audit objectives, except that they focus on presentation of the financial statements and on the footnote disclosure information that accompanies those statements. They also follow from management assertions, and they provide a framework to help the auditor accumulate sufficient appropriate evidence related to account balances. In contrast to the 6 transaction-related audit objectives, there are 8 general balance-related audit objectives. The first objective of existence deals with the amounts being included in the financial statements should actually be included, followed by the objective of completeness that deals with all amounts that should be included have actually been included. Next is the accuracy objective that refers to amounts being included in the financial statements were stated at the correct amounts. The classification objective deals with the amounts included in the client's listing were properly classified. The cutoff objective involves transactions near the balance sheet date being recorded in the proper period. The detail tie-in objective involves details in the account balance, agrees with related master file amounts, foots to the total in the account balance, and agrees with the total. The realizable value objective deals with the assets being included at the amounts estimated to be realized. And lastly, the rights and obligation objective involves the assets being owned or controlled by the entity, and liabilities were obligations that belong to the entity. Because of the way audits are performed, balance-related audit objectives are almost always applied to the ending balance in the balance sheet accounts. However, some balance-related audit objectives are also applied to certain income statement accounts. After the general balance-related audit objectives are determined, specific balance-related audit objectives for each account balance on the financial statements can be developed. At least one specific balance-related audit objective should be included for each general balance-related audit objective, unless the auditor believes that the general balance-related audit objective is not relevant or unimportant for the account balance being considered. In some instances, there may be more than one specific balance-related audit objective for a general balance-related audit objective. In here, we have an example of the relationship among management assertions, the general balance-related audit objective, and the specific balance-related audit objective. Just take note that there is a one-to-one relationship between assertions and objectives, except for the valuation and allocation assertion. The valuation and allocation assertion has multiple objectives because of the complexity of valuation issues and the need to provide auditors with additional guidance for testing valuation. Please read Table 6-5. You can find Table 6-5 on page 165 of your textbook. In here, we have an example of the relationship among management assertions, related general presentation and disclosure related audit objectives, and the specific related audit objective, which in this example we have the notes payable accounts. The presentation and disclosure related audit objectives are identical to the management assertions for presentation and disclosure discussed previously. The same concepts that apply to balance-related audit objective apply equally to the presentation and disclosure audit objectives. Please read Table 6-6, and you can find this table on page 165 of your textbook. The auditor must decide the appropriate audit objective and the evidence to accumulate to meet those objectives in every audit. To do this, auditors follow an audit process. We will discuss the audit process as it relates to the audit objective and the accumulation of audit evidence. The audit process is a well-defined methodology for organizing an audit to ensure that the evidence gathered is both sufficient and appropriate, and that all required audit objectives are both specified and met by the auditor. The audit process, as described in your textbook, has 4 phases. Phase 1 of the audit plan involves planning and designing an audit approach based on risk assessment procedures. The main objective of an audit is to accumulate enough evidence to provide an opinion on the financial statements. 2 overriding considerations affect how an auditor approaches the audit. First, there should be sufficient appropriate evidence that must be accumulated to meet the auditor's professional responsibility. And second, the cost of accumulating the evidence should be minimized. The audit plan should result in an effective audit approach at a reasonable cost. The auditor performs procedures to assess the risk that material misstatements in the financial statements may be present. Those risk assessment procedures are a critical component to planning and designing an audit approach, which can then be broken down into several parts. The 3 key assessment procedures that the auditor performs include obtaining an understanding of the entity and the entity's environment. The auditor identifies internal controls and evaluates their effectiveness. Evaluating the effectiveness of internal controls is a process called assessing control risk. And lastly, the auditor assesses the risk of material misstatement in the financial statements. Phase 2 of the audit process involves performing tests of controls and substantive tests of transactions. Tests of controls allow the auditor to evaluate the effectiveness of internal controls and determine whether the controls can be relied upon to reduce planned control risk. In contrast, substantive tests of transactions allow the auditor to evaluate the client's recording of transactions by verifying the monetary amounts of transactions. Phase 3 of the audit process involves performing substantive analytical procedures and tests of details of balances. Analytical procedures consist of evaluations of financial information through analysis of plausible relationships among financial and non-financial data. When analytical procedures are used as evidence to provide assurance about an account balance, they are referred to as substantive analytical procedures. Tests of details of balances are specific procedures intended to test monetary misstatements in balances in the financial statements. The tests of details of ending balances are essential to the conduct of the audit because much of the evidence is obtained from third-party sources and therefore is considered to be of a higher quality. Phase 4 of the audit process consists of the completion of the audit and the issuance of the audit report. After the auditor has completed all procedures for each audit objective and for each financial statement account balance and related disclosure, it is necessary to combine the information obtained in order for the auditor to reach an overall conclusion as to whether the financial statements are fairly presented. When the audit is completed, the auditor must issue an audit report to accompany the client's financial statements. In here, we have a summary of the 4 phases of the audit process that we have just discussed in the previous slide. Please read figure 6-8 and you can find this figure on page 166 of your textbook. We have reached the end of the discussions for Chapter 6. In this chapter, we covered management's responsibility and assertions, the auditor's responsibility and the audit process, using cycles when performing an audit, and the audit objectives. Please complete the required evaluation method for Chapter 6 as it will be part of your final grade. The homework and quiz are to be submitted on the specified due date. Please use Blackboard and Pearson's MyLab to complete your homework and quiz. You have reached the end of the course presentation for Chapter 6. Please access the video for Chapter 7 for the next presentation of the course.